Wall Street is watching, again, and this time all eyes are locked on NVIDIA. It's Wednesday, May 21st, 2025, and the financial world is holding its breath. NVIDIA, the undisputed leader in AI chips, is about to report its Q1 2026 earnings. Markets are on edge, not just because NVIDIA has become one of the most valuable companies on the planet, but because what happens next may tell us whether the AI boom is real or just another bubble ready to burst. Let's start with what brought us here. Over the past 24 months, NVIDIA's rise has been nothing short of meteoric. Fueled by unprecedented demand for generative AI, machine learning, and data center acceleration, NVIDIA's GPUs, graphics processing units, became the gold standard of modern computing infrastructure. Companies from Silicon Valley to Shenzhen rushed to buy their H100 and more recently the Blackwell B100 and B200 chips. These aren't just expensive tech toys, they're the engines behind ChatGPT-like models, autonomous systems, recommendation algorithms, and entire national defense AI strategies. In early 2023, NVIDIA's market cap crossed $1 trillion. By early 2025, it was hovering near $2.3 trillion, putting it among the ranks of Apple, Microsoft, and Saudi Aramco. And yet with that scale comes pressure. Immense pressure. Because when you're priced for perfection, even the smallest crack can cause an earthquake. And a few cracks have started to show. At this week's Computex conference in Taipei, NVIDIA CEO Jensen Huang made headlines. Speaking to reporters, he called US export restrictions on China a colossal mistake, stating that they've already cost NVIDIA over $5.5 billion in quarterly revenue. China, which once accounted for 95% of NVIDIA's data center shipments in Asia, now represents just 50%. That is a staggering decline. And it's not a demand problem. Chinese firms still want NVIDIA's chips. It's a political wall that's been built in the name of national security, and NVIDIA is stuck on the wrong side. This geopolitical tension has become one of the biggest headwinds for NVIDIA and the AI sector more broadly. It's not just about sales. It's about innovation, supply chain reliability, and the fragmentation of the global tech ecosystem. And Wall Street is paying attention. Let's talk numbers. For Q1 fiscal 2026, consensus estimates are projecting around $43 billion in revenue, up roughly 65% year over year. Earnings per share are expected to come in between 87 and 93 cents, depending on who you ask. These are blockbuster numbers, historic even, but they're also the minimum expected. And that's the dangerous part. When investor expectations are this high, even a beat can feel like a miss. NVIDIA could exceed revenue and earnings projections, but if its forward guidance falls short, if margins shrink, if export losses expand, if data center demand cools, stocks could slide. That's exactly what happened last quarter. NVIDIA beat expectations across the board. And what did the market do? The stock barely moved. Why? Because the gains were already priced in. Wall Street wasn't looking for great numbers. It was looking for astonishing ones. So the question is no longer, is NVIDIA doing well? The question now is, can NVIDIA continue doing the impossible? Let's examine some of the structural pressures building behind the scenes. First, the Blackwell chip transition. NVIDIA's newest AI chips are expected to be significantly more powerful, but also more expensive to produce. The company has ramped up capital expenditure, investing in advanced packaging, new manufacturing processes, and larger silicon wafers. All of that takes time, and it eats into margins. Second, there's the rising competition. While NVIDIA remains dominant, AMD, Intel, and even homegrown Chinese AI chipmakers are rapidly advancing. Huawei has launched its Ascend series. Alibaba is developing its own AI processors. Even Amazon and Microsoft are experimenting with in-house chips to reduce dependence on NVIDIA. Third, and perhaps most crucially, is regulatory risk. The US government has made it clear national security trumps business interests. New export controls are likely. Tensions with China are escalating, and Taiwan, where many of NVIDIA's chips are manufactured, is in an increasingly vulnerable position. Any disruption in this chain could send shockwaves through the AI supply ecosystem. So what does all this mean for the AI sector? In short, volatility. NVIDIA isn't just a tech company anymore. It's a bellwether for the entire AI economy. Its performance affects semiconductor indices, ETF baskets, and institutional portfolios around the globe. When NVIDIA moves, the market moves with it. Look at the Magnificent Seven: Apple, Microsoft, Meta, Amazon, NVIDIA, Tesla, and Alphabet. Together, they account for over 30% of the S&P 500's total market capitalization. That's unprecedented concentration. And it means that any earnings surprise, positive or negative, has outsized impact. But let's shift gears for a moment. What does this mean for you, the retail investor? If you're holding NVIDIA stock right now, you're probably sitting on significant gains. But you're also exposed to massive expectations. If NVIDIA beats earnings, the upside may be limited, perhaps a few percent. But if it misses, the downside could be brutal. It's the definition of asymmetrical risk. Some analysts suggest trimming positions ahead of earnings. Others argue that long-term demand for AI infrastructure justifies holding through the volatility. And a few are even calling this a buy-the-dip moment. If weakness emerges, it may offer the best entry point for the next decade. But before you decide, ask yourself this: what's your time horizon? If you're a short-term trader, NVIDIA's next move could be binary, boom or bust. But if you're investing for the next 5, 10, or 20 years, the bigger story may matter more than the next earnings call. Because the AI revolution is real. Governments are pouring billions into AI development. Enterprises are rebuilding their data centers. Startups are raising capital to build LLMs, foundation models, autonomous agents, and digital infrastructure that simply didn't exist 5 years ago. And all of them need compute. They need GPUs. They need NVIDIA, or someone like it. The challenge, of course, is valuation. Can NVIDIA justify a $2.3 trillion market cap? Can it sustain 60 to 70% annual revenue growth? Can it fend off competition, navigate geopolitics, and still innovate faster than anyone else? Maybe. But it won't be easy. Here's the broader perspective. Every major tech revolution has a hype cycle. In the 1990s, it was the internet. In the 2000s, it was mobile. In the 2010s, cloud computing. And now, it's artificial intelligence. Each cycle started with speculation, saw massive capital inflows, triggered a bubble, and then a crash. But in the long run, the real players survived. Amazon lost 90% of its value after the dot-com crash, but went on to become a $1.8 trillion company. So the real question isn't whether there's a bubble. The question is whether NVIDIA is Amazon or Pets.com. Most believe it's the former. And that means the next 5 years could be bumpy, but ultimately transformative. Before we wrap up, a quick look at the broader implications. If NVIDIA misses earnings, expect a sector-wide correction. AI stocks could fall, retail sentiment may dip, and mainstream media will start shouting, "Bubble." If NVIDIA beats, we could see a new rally, especially in semiconductors and data center plays. Watch the bond market too. Rising interest rates have historically pressured high-growth tech stocks. If inflation ticks higher, the Fed may hold or even hike, another headwind for stocks like NVIDIA. In other words, this is a moment of convergence. Macro meets micro, policy meets innovation, hype meets reality. And you, the investor, are right in the middle. So stay informed. Diversify wisely. Think long-term. And remember, sometimes the best opportunities come when everyone else is panicking. Thanks for watching. Be sure to hit the subscribe button, leave a comment with your take on NVIDIA and the AI sector, and share this video with others who follow the future of finance and technology. This video is for educational purposes only and does not constitute financial advice. Please consult a licensed financial advisor before making any investment decisions.